Everyone. Let's take a look at this problem dealing with break-even point. It's problem 16-7. Schwesser Satellites produces satellite earth stations that sell for $100,000 each. The firm's fixed costs, F, are $2 million. 50 earth stations are produced and sold each year. Profits total $500,000. And the firm's assets, all equity financed, are $5 million. The firm estimates that it can change its production process, adding $4 million to investment and $500,000 to fixed operating costs, and the change will reduce variable cost per unit by $10,000 and increase output by 20 units. But the sales price on all units will have to be lowered to $95,000 to permit sales of the additional output. The firm has tax loss carryforwards that cause its tax rate to be 0, its cost of capital is 16%, and it uses no debt. Alright, there are 3 requirements to this problem. Requirement A asks us to answer the following questions. What is the incremental profit? To get a rough idea of the project's profitability, what is the project's expected rate of return for the next year, defined as the incremental profit divided by the investment? And should the firm make the investment? B asks us to answer the question, would the firm's break-even point increase or decrease if it made the change? And C asks us to answer the question, would the new situation expose the firm to more or less business risk than the old one? Okay, I'm going to illustrate how we would solve this one using Excel. And I've staged the problem ahead of time just so that the demonstration doesn't drag on. Okay, so what I would do is lay this one out using a very simple income statement. I would take revenues less variable costs less fixed costs equal profits. Okay, and they've given us certain key pieces of information. They've told us that the number of units sold was 50, and they've told us that the price per unit is 100,000. So if we multiply the 100,000 times the 50 units, we know what total revenues are. Now they haven't given us variable cost, but they did give us fixed cost, and they said fixed costs are $2 million, and they tell us profits are 500,000. Therefore, we can back into variable cost using the formula you see here. Let me hit the F2 key, which is just take revenues minus the sum of the fixed costs and the profits, and that amount has to be variable cost. So when we do that, we come up with 2.5 million. And just to complete the per unit items, we can divide all of that by 50 units, right? So if we just divide every dollar amount by 50 units, we're able to determine what the profit per unit is. Okay, then we have a proposal, and in the proposal some things change. One thing is they tell us the selling price has to drop to 95,000. They tell us the fixed cost go up to 2.5. So what I've done is taken the 2 million plus the 500,000. I think that's how they've actually given it to us in the problem. And they tell us variable costs will go up. Hang on one second here. What exactly did they tell us? They tell us variable cost will drop by $10,000, right? So that drops by 40,000. And we know that this is 70 units, so we can divide that out. Once we have the 95,000, we can simply multiply the 50 plus the 70 units times the 95,000. Now I've done it as the 50 plus 20 times F3, but really what we could do is enter this as a 70 because they've told us it increases by 20 units, and then multiply the 95,000 times the 70 units, right? And we come up with our new sales amount. All right, we know the variable cost per unit, so now all we need to do is multiply the variable cost times the 70 units. And I think rather than typing it in, it makes more sense just to reference it. It comes from cell F8, right? So from there, we can just do the math, and we come up with a new profit of 1,350,000. And then if we divide that by 70 units, we come up with a profit of $27,000 per unit versus 10. And then the last part of question A says, what's the incremental cost should the firm make the investment? And the incremental cost on part A, or the incremental profit, we just compare the profit of the new versus the old, and we come up with $850,000. Okay, now I've moved up the number of units sold one row. Actually, I hid row 7, as you can see, just to give me a little bit more screen real estate to continue answering the questions that they asked on this one, which is, get a rough idea of the project's profitability. Well, if we look at return on investment, we see that we've got, let me do it right here, we've got an $850,000 incremental profit, and I think the incremental production process was going to require $4 million of new capital. So we'll just take that number there, and what we come up with is a what is that? 21. We'll call it a 21.225% positive return on investment as a result of making these changes. Now, because it's positive, that tells us, and it's highly positive, right? I think they told us that the cost of equity is 16%, and with a 16% cost of equity, we're looking at an incremental profit of 21.25% in terms of return on investment. So based on the analysis we see, this looks like a smart decision and something the firm should go ahead with. Part B asks us to determine whether the firm's break-even point increases or decreases if we make this change. Okay, so on the screen you see right here, in this area here, I've entered the formula for break-even, which is fixed cost divided by contribution margin. And if we solve this one, and I've done so ahead of the time, I'll just show you how we can calculate that. You would take the fixed cost, which is the $2 million given in cell B5, and divide it by the contribution margin. And the contribution margin, and that's per unit, is simply revenues per unit less variable cost per unit. So we would subtract C4 from C3, use that as the denominator, and we see that the current situation, we've got a break-even equal to 40 units. Now if I just copy that over here and hit the F2 key, we see the same calculation, and as a result, break-even rises from 40 units to 45.45. Okay, Part C then says, would the new situation expose the firm to more or less business risk than the old one? And let me answer that. Okay, it's impossible to state unequivocally whether the new situation would have more or less business risk than the old one. We probably would need more information on like the probability of sales, or in other words, the sales probability distribution, maybe some idea of the uncertainty about variable unit costs in order to make this determination. Okay, but without that information, a higher break-even point, other things being held the same, tells us that there's more risk involved, because we simply have to achieve a higher sales level before we return the investment that we've put into making this kind of proposal change. Now, you could also solve this problem algebraically if you'd like, rather than using Excel. And how you would do that is shown on the screen here. You could determine the variable cost unit at present using the following formula, right? Price times quantity minus fixed cost minus variable times quantity. And as we solve for the unknowns, we determine that V would be equal to 50,000. Then on part 2, you could determine the new profit level if the change is made by putting in the 95,000 price per unit times the 70 units, subtracting the 2.5 million variable cost that we've already solved, and working our way down, and then subtracting fixed cost as well, and the variable cost. I'm not sure I said that correctly, but you come up with $1,350,000, and then in part 3 comparing the profit new to the profit old to come up with the incremental profit. And then on part 4 you could estimate the approximate rate of return simply by dividing by the profit divided by the investment. We come up with 21.25%. Now, since that exceeds the 16% cost of capital, even though it says 15% here, I think the problem said it was 16%, the analysis suggests that the firm should go ahead with the change. And then part B says calculate the change in break-even point. So the quantity at break-even, which was fixed cost minus price less variable cost, was 40 units, and then algebraically you see the change, the 2.5 million of fixed cost divided by 95,000 minus 40,000, and we see that break-even rises from 40 units to 45.45 units.